Hey, my name is James Nicholson and welcome to my YouTube channel. This video is going to trigger people in the comments for sure. I'm going to talk about a lender, one of the biggest lenders in the UK that is today increasing interest rates and decreasing interest rates at the same time. Wow, I'm looking forward to reading all the comments on this one. This is down to the market at the moment, the volatility in the market, and that is also down to the budget. A lot of banks, institutional lenders, there's some uncertainty and they really don't know what Labour are going to do and the impact that it's going to have, and markets react ahead of time. So as an example, the Bank of England are likely to cut interest rates again this year, and that stuff gets priced into stocks and shares and all those sorts of things ahead of time. So in this video, let's talk about who the lender is, why they're increasing rates and decreasing rates at the same time, how is that even possible, and much, much more. So before we jump into this, as always, if you haven't done already, do subscribe to the channel over there and hit the bell notification. We've got new content on property prices, interest rates, mortgage rates, property investing every single day. And while you're here, smash like, tickle like, do something to that like button. That really, really helps with the YouTube algorithm and has really helped the channel grow. So I appreciate everyone that takes a moment to do that. So who is the lender that we're talking about? It's HSBC. Very, very big lender. And one of the bigger banks in the world. And they are reanalyzing all of their portfolio. And a lot of this is down to the swap rates. So I know a lot of you know what that is, but just in case you don't, the swap rate is the rate of interest that someone like HSBC can borrow at. So HSBC, NatWest, Santander, they are big banks to us, but they borrow from even bigger banks like JP Morgan, and they borrow on something called the swap rate. Now, that takes into account lots of different things. And when the market was quieter this summer, the swap rate went down, even before the Bank of England cutting interest rates. You see, they wanted to stimulate the market and get lending happening again, because at the end of the day, banks make money with money moving around because transaction fees happen, and that's how they get even bigger. And so when the market slows down for them, it's not good. And so they cut mortgage rates in the summer, and that did get the market moving again. It got some good momentum, which we're starting to see in house price figures and data and videos that we've been talking about recently. And so right now, the swap rate, the SONIA swap rate, has been going back up. And that's happening because they're uncertain about Labour's budget. There's quite a lot of stuff being talked about in the press. A lot of big businesses now are saying potentially they will leave the country and offshore business because they don't like the new tax rules that the government are talking about. And that's not good for our economy. That's not good for employment. And that is the perception at the moment. Now, Labour have tested the market. They've talked about potentially raising capital gains tax to 39%. They talked about that in speeches and leaked that stuff out to the press. That didn't go down very well. So Rachel Reeves has then had interviews and stuff where she's now talked it down and said, for properties, this won't increase. You see, capital gains tax for property investments was as high as 28% at one point. The Conservatives brought it down to 24%. So she's clarified that in the budget next week, it's unlikely that they will, in that budget, increase capital gains tax for property. Now, for stocks and shares and stuff like that, it will go up. And people that run businesses, if they sell their business, that will go up significantly as well. And that's why business owners are saying, well, we'll just offshore the business. There's no, in this type of world that we have now, there's no real anything tying you to a particular country anymore. So that's why the markets are reacting potentially badly to this. And so HSBC is acting because the swap rates, the rate of money that they borrow from, has gone up. So here's what they're intending to do today and tomorrow. So right now, their lowest rate is 3.82%. And that's if you have a 40% deposit. Now, when I've talked about mortgage rates going down, often the best deal has been for those with the biggest deposit. It still is. It makes sense because it reduces the risk for the lender, doesn't it? If you were going to lend someone money, would you rather lend someone that owns a 100 grand house, 50 grand, or would you rather loan them 90 grand? It's way less risky to loan them 50 grand because if there was a problem and you needed to repossess the property, you'd have that 50 grand in equity. So that's why you normally get the better deals at that end. Now, HSBC have announced that they will be increasing the rate on their best deal. So the best deal is now getting worse. They haven't said how much this is going up to, but I would expect with the other lenders that we've seen recently that it will go up, I would predict, around 1/4%. A 1/4% is what I would say. I'll be very surprised if it wasn't that much. That's what we've generally seen. So this deal will go up by 1/4%. So that is an increase in interest rates. However, in the same statement, they are cutting their rates on the deals that have a 20% deposit or less. So these deals are more expensive. They have rates of around 5.8, 5.9, those sorts of ballpark figures. They're not below the 4% deals. They're more expensive to borrow money. And they want to get more competitive at that end of the market. Now, this end here, their margins would have been very low on that. And so that was very close to what you could have got, what they borrowed money out. They put a little bit on top. They probably didn't make loads on that, but they were very safe lending. So what they're looking at is the slightly more risky, but still safe, 20% deposit sort of deals, that sort of area, reducing that to get more competitive and focusing on bringing in deals and borrowers at that end of the market. Now, this is not something that other lenders have particularly been doing, but I think that you might start seeing more of this now because the margins are too low at this end of the market. They can't really offer that until the swap rate drops again. It could drop after the budget. So once we have the budget on Wednesday the 30th, potentially at that point, you could see a significant drop in the swap rate if the government don't go as aggressive on tax hikes as they potentially talked about. And we are seeing Labour are leaking details on stuff to test the market, as I said, and also just try and stabilise the market because they don't want to have a budget similar to Liz Truss. So it's going to be very interesting. My advice is the same as always. If you have a mortgage deal that expires in the next 6 months, start speaking to a broker now, get a deal agreed in principle, fix that rate. If during that time that you're waiting for that deal to start, let's just say you agree the rate today, your deal starts in January. If mortgage rates drop, you can swap on to the lower rate. If mortgage rates increase, you fixed in at that better deal. That's the smart advice at the moment that I'm telling people to do. Tons of you in the comments have done that, but it's an interesting market. I'm sorry, I can't change the title of the video. Interest rates are going up in some areas. Interest rates are going down in others. Let me know your thoughts and opinions in the comments below. Do smash like. Do check out all the other content on my channel, including this video right here.